All right, good morning to everyone. It's beginning of week 6, and we're going to finish up talking about some of the content out of chapter 12 today. And notice the syllabus itself has the due dates for the chapter 12 materials as of last week, but I moved that and advanced that forward to October 6th. So that's coming up this Sunday. So notice you'll have a discussion activity, and if you haven't posted that yet, I'd urge you to sort of do that sooner rather than later if you would. It just kind of helps move the discussion along. And since there are required reply posts that are needed, the earlier people can post to them, that's all to the good in that regard. So, okay, so we've got that. One more quiz bonus to those we do on the 6th. Also, we have our first exam that's coming up on, well, it's this week. It's actually available now. So it should be, if you're looking at Brightspace, it's available. It's going to be available until Sunday the 6th. It's going to close right at 11:59. Give yourself some time to prepare for that. My plan for this week is I want to finish up talking about some of the content out of chapter 12 and make sure that everyone is familiar with what's going on with the content. And then I don't think we're going to be able to, from a time standpoint, I don't think we're going to be able to do any of the chapter problems and exercises, but I think I will on Wednesday. And then really, I think you'll find those to be relatively straightforward. And then in the sort of the back half of that class period, about 45 minutes or so, I'll try to carve out some time to talk about the exam. I do want to do a review session for that, just to kind of let you know what the format of the exam is, what to expect, what kind of questions you're going to be seeing, etc. So that's kind of my plan for chapter 12. And so hopefully we'll be able to get through all the rest of the material today that we need to cover, dealing with job order costing. And we're sort of in the part of this chapter now where we're dealing with what do we do with overhead costs. And that's really the main sort of issue that we're covering right now. So we'll jump into that before we get going. I know we have a number of people on the live Zoom. Anyone have any questions, either here or in the classroom or on the live Zoom link? Okay, well, if you do, feel free to just give me a shout out. We can certainly accommodate any of your questions. That's perfectly fine. So I think where we ended up, and I sort of flagged my notes, was that we have about two more, I guess about three more learning objectives to cover in this particular module. And we're going to talk about overhead. And remember, we talk about the issue of product cost. And it's something we've talked about before. In the last chapter, we differentiated product cost from period cost. Period cost are those accounting costs which really aren't related to the product itself. We call them period costs because we sort of measure them from start to finish based upon the accounting period, the quarter, the year, whatever that we're dealing with. And so we talk about product costs, we're talking about direct materials, direct labor, and manufacturing overhead. We're going to talk a lot about this today as to what to do about manufacturing overhead. One of the things that we talked about earlier was the idea that it's an indirect cost, and as such, it's got there's some difficulties in applying it to individual product costs. So when we talk about these costs here, and I'm sure you have these in your notes at some point, but we talk about these as manufacturing or product costs, and these are categories. These aren't individual costs. These are categories of costs. We say these are costs that are directly attached to and are applicable to the individual products that are being produced, products or services, whatever the case might be. And so in the case of overhead, remember there are two main definitions of what manufacturing overhead are, which sort of put it in the indirect category. That is, number one, the costs are so indirect that they can't be logically applied to any particular one output, whether it's the plant manager's salary or inspectors that move around to different production areas, security guards. Those would be examples of indirect labor, or things like indirect materials that simply don't really apply. And then in the case of indirect materials, the other major definition there is that they're just too small, too obscure to attach to a product. And these would be all kinds of things like packaging and adhesives and paint and finish and cleansers and all these gloves and all these kind of things that are used in the production process, but really are difficult to attach to the product. So we have to have some method. We have to have some technique by which we take these costs that we're incurring and to be able to attach those to product costs themselves. First, let's do a little bit of a roundup here, and we're going to go back just a. We're going. Oops, what did I do here? I'm going too far here. Well, I'm going to go not back in terms of where we are in the module itself, but kind of back as a bit of review in order for us to sort of get our arms around what is going on with manufacturing overhead costs. So the difficulty is that we really can't take these costs and say that these are the actual costs that apply to these actual products. What we have to do is we have to estimate these costs, and then we apply them. And so we'll talk about this idea of application of overhead cost. And we'll talk about why that's the case, but some of the input that I wrote here was that by definition, overhead costs are indirect because, and some of this I've just mentioned, but they're too small to adequately capture as direct costs. They're too general, that is, they're too indirect, like the example of a security guard and whatnot. But they are nonetheless what we would call real costs or hard dollar costs. These are actual expenses that are paid, not just incurred, as with what we would call soft dollar costs. And I don't want to spend a lot of time getting off into this distinction between soft dollar and hard dollar. Soft dollar costs is simply usually any kind of cost that's transferred from one department to another. Like we've done something for you, and so we're going to, you're going to incur the cost of that. Maybe we've loaned you an employee, and so as a result, you're going to absorb their labor. It's all organizational in the end. But the point I want to make is these are real costs that someone that we've incurred, either because we've written a check for these costs, as in the case of things like property taxes on the equipment, or property taxes on the building, or insurance on the equipment, or whether we've not written a check, as in the case of depreciation on the equipment. But they're still what we call actual costs. And they're also what we call explicit or accounting costs, and they're not implicit or opportunity costs. Now, what are those? I know that I periodically ask students if they've taken microeconomics first. Have you guys taken microeconomics? Okay, well, if you haven't, you'll come back to this at some point. And if you haven't, that's fine. You're in no way handicapped. The point we want to make, though, is that when we talk about implicit costs, we are capturing the opportunity of, or the lost value of some opportunity that we've foregone. Okay, opportunity costs. Accountants stay away from opportunity costs, or what economists sometimes call implicit costs, almost with they want to account for those costs which are measurable, verifiable, reliable. That's what the accounting function seeks to do. So these are real costs. And by the way, as we get toward the very end of this discussion, we'll see how these real costs then, these actual costs, compare against what we've estimated and attached or applied to individual products themselves. Okay, so what do we do in order to take these obscure costs and put them on individual products? We have to establish an overhead rate. And there are a number of different ways of doing it. I'll give you the most basic way here, and it's the way that the textbook presents it. And I think it's really the easiest way to understand how to attach these obscure. Well, I should probably say the word obscure. Maybe they're not that obscure, but they're indirect. They're kind of hard to grasp onto. How do we apply them? And so part of it's arising through the budgeting process. We're going to come back and talk much more about budgeting a little bit later in the class, because we're going to talk about what budgeting is, how budgets are put together, and remember that one of the key objectives of managerial accounting is to be able to manage and measure management performance. And so we do this often by comparing their performance to the budget. And the budget has got a lot of different terms: forecast, roadmap, game plan, whatever you want to call it. And a lot of times they're based on historical numbers. And so it's very often the case that what happened last year is probably going to happen the next year. We may make an adjustment upward a little bit for rising prices of things. And so it's not at all the case that every year is a brand new game with a whole new slate, because sometimes, particularly from the standpoint of costs, they don't change that much. And one of the big costs, keep in mind, are labor costs, which really don't change that much over time. Materials costs, they can, certainly, no question about it. And so we have to have something to hang our hat on. And we're going to latch on to what we call activity base. And then the term of art here is called a driver. And that is, we need to be able to measure something that is a stand-in, is a proxy for activity going on in general. And if we can measure that, and these have got to be measured, there's no question about it, they've got to be measured accurately. If we can measure that, then we can apply overhead to the production of goods themselves. And right now, if this is a little bit unclear, it'll become clearer here a bit later. So when we talk about examples of what these drivers are, these things that we're trying to hang our hat on, some of the most common ones are direct labor costs, which are a dollar figure, or direct labor hours, which are in numbers. And labor, historically, labor was sort of the default standard for costs in any kind of format, whether it's manufacturing or service or whatever else. Labor was usually sort of the default go-to driver. Today, it's not so much the case. In fact, as we get a little bit deeper into the class to talk about what we call activity-based costing, we'll talk about some other drivers. But for right now, let's just look at a driver as something we are hanging our hat on, and that we're applying a dollar figure to the activity that the driver is associated with, and that we can put that into the cost of the product itself. In other words, we can make that an inventoriable cost. Oftentimes, I will say this, that this is not as speculative as what it might seem like. And if you look at some of the distinction between labor and machines, in other words, what we call labor-intensive production or capital-intensive production, and the term capital-intensive just refers to how much in the way of long-term assets are being used to make those goods, machines, basically. If there's a lot of capital intensivity, then probably machine hours will be used. That's probably a good stand-in, and we're going to certainly see some examples of how those might apply. But even in a manufacturing context, labor is oftentimes used, and certainly in the service sector relationship, we're going to see that. So, because one of the reasons that service sectors are so easily associated with labor is it's far and away the biggest cost in most cases for service. That is, companies that don't deal with inventory, they just deal with the service. Labor is the big cost, and therefore is a logical driver for associated overhead with. Okay? All right, so let's talk a bit about the budgeting function. This is an equation for coming up with a rate, okay, and arriving at a percentage here. So if we are going to use, I think it's labor hours is what the example we're going to use here is, and we'll get to that in a second. But when we talk about this predetermined overhead rate, it's established at the beginning of the year, or what is more likely, I think, particularly for bigger companies, is the ending of the prior year. And a lot of companies will do their budgeting in that sort of fourth quarter of whatever fiscal year they are. Remember, companies have all kinds of different fiscal years or budget years. They don't always correspond to the calendar year. Sometimes they might end on March 15th or something. I mean, it's just whatever makes sense for their particular business. But they'll often do the budgeting function around the end of one year in order to project what's going on in that next year. And when we're talking about smaller companies, they might use one single overhead rate. Large companies might have hundreds of different overhead rates. And obviously, accountants aren't responsible typically for understanding all those hundreds of rates. It's usually it's divided by area and oftentimes by different geographical areas and different kinds of production and whatnot. And so these rates can vary, though. That's really the thing. And one of the determining variables here is the degree of labor versus capital intensity. So here's one equation that is taking the estimated annual overhead costs as part of the budgeting function. And where might this number come from? We might say, well, last year we spent X dollars on overhead. And we know it because these are, again, hard dollar costs that we have incurred. They hit the income statement. So as a result, we know what they were last year or this present year, but we're looking forward and we're saying this is what we think they're going to be. And then we think there's going to be some sort of operating activity. In this case, we're using a dollar figure, but again, it could be numbers like in labor hours or machine hours, and in which case we're going to have a different variable. Here we have a dollar figure divided by a dollar figure. We're going to have a percentage, okay? And then that percentage will apply to the driver, which is the activity that we're hanging our hat on. So in this case, what do we have here? We've got whatever the activity base is times the overhead rate, then goes where? It goes to inventory, okay? Specifically work in process inventory. So like these slides are, the way they've ordered these are a little bit out of order. I think I would have probably reordered these two slides here just because we were talking here about this idea of a predetermined overhead rate going back here where we got the estimate for total costs for the year. And again, if it's, this could be for a division, a department, for a subsidiary, whatever the case might be, but if we estimate what it should be for the year divided by some operating activity, which in this case is going to be expressed in dollars, we're going to get a percentage. And so in this case, what is the example that we're using here? We're using direct labor. So, and we're back to this Wallace company, which we've been following their exploits here as we've been moving through this chapter. And they're going to use direct labor cost, that is labor dollars, as the activity base or the so-called driver. The term driver is one that I'm just introducing now. I don't believe it's even discussed in chapter 12, but it will come up a bit later. And so in this case, they're saying, look, we expect annual overhead cost to be $280,000 based upon what we think is going to happen. It's an estimate divided by what we think the labor costs are going to be. And so we're saying estimated overhead 280, estimated labor cost 350. 80% then is what's applied to overhead rate. And what to overhead, that is these costs that are inventoriable based upon overhead. Okay. Now, up to this point, this is sort of a missing piece of the puzzle that we really haven't gotten to yet, because up to this point, with this Wallace Company example, we've done things like incurred costs for materials, and some of those have been direct, and they've gone straight to work in process and inventory account. It's an inventoriable cost. Others, like indirect materials, go first to overhead. It's a preliminary step. In the case of labor, we've got direct labor that goes directly to work in process. Indirect labor will go to manufacturing overhead for now, okay? And at some point, we will move all these costs over to work in process. And we'll hopefully get through this process today, so you'll see what's going on. So in other words, when we are taking overhead and we're applying it, what we haven't done is we have applied materials and labor to inventory cost, and we put them in a work in process, which is that temporary inventory account. Remember, these are inventoriable costs. What we haven't done yet is moved over manufacturing overhead. We're going to do that at a rate of 80% of the incurrence of direct labor costs. So for every dollar of direct labor, we're going to assign 80 cents to overhead for that particular job. Okay. And some of the criteria for choosing an activity base or a driver is it's got to be fairly easily measurable. It can't be based upon something that's random or difficult to measure or something that has no relationship at all. Labor is a pretty good stand-in because usually labor is the cost of labor will vary proportionally with the activity that's going on. And so even though labor is really direct labor in particular, doesn't have anything to do with overhead, it is a proxy for activity, and activity is a way that we achieve the absorption of overhead cost into individual products themselves. It'll become clear as we get going, I think. So every dollar of direct labor, then we just simply attach 80 cents of manufacturing overhead to a job, okay? And then, as I mentioned a minute ago, if you take that, whatever that activity base is, in this case it's labor dollars, times the rate, which is 80%, then we simply apply that to various jobs within work in process. And I know earlier in the chapter, your book got into talking about subsidiary ledgers. And any subsidiary ledger is simply a subset of a larger category of accounting value. In this case, these individual jobs. The costs are captured by individual costs. They all fold in, individual costs, and they all fold in to the actual good itself. Okay? All right, well, in this case, we go back to our friends at Wallace, and they apply manufacturing overhead to work in process. So, so in this case, they incur $28,000 of direct labor for some particular accounting period. And we said 80% of direct labor cost then goes to manufacturing overhead. So as a result, we simply take 22,400, which is 80% of 22 or 28,000, and we put that in a working process. But let me do this because I know it's been a few days since we looked at this, and I do think it's important for us to sort of go back and regroup and say, where do these numbers come from? Because I'm just kind of throwing you out on that one slide some numbers. But remember, at the end of this, this is where we sort of ended up things. We had raw materials, and we had a balance in that. We had labor. There is no balance in labor. You know, it's either attached to direct or indirect. But we had a balance of 23,800 in manufacturing overhead. These are real costs that were incurred. They just haven't been applied to jobs yet. They've just been incurred. And remember, we started out with I think we started out with 13,800, and we had 6,000 of direct materials, I believe. And then we just had 4,000 of indirect materials. So we had 13,800. It was based on all kinds of things, insurance on the building and all that. And we had 6,000, which brought us to 19,800. Now 4,000, which was this last entry into manufacturing overhead, where we picked up 4,000 of indirect labor and put that into manufacturing overhead. Okay. So I just want to make clear where these numbers came from. We are using the same example here in this case. Work in process, notice, as a balance. And we don't have dates here. It might be easier if we had dates so we could say, hey, flip back to whatever day. But anyway, it's, you know, we can refer back to what's been presented. We have work in process here. We had 24,000, then we had 28,000 of direct labor being attached to it. So we had work in process of 52,000. So kind of remember these figures here as we go down to look at this example here. So in this case, we're now going to start putting manufacturing overhead into work in process inventory. We had 23,800. For this particular accounting period, again, we incurred, or we have attached 22,400 out of manufacturing overhead to work in process. Okay, and right now, these are not subsidiary accounts. These are big scale accounts. Work in process is a balance sheet account. And remember, we would report work in process on a balance sheet when we're cutting off an accounting period, right? These are goods that are not yet done. And we'll talk about the analog to that in the service sector here in a second, okay? So we've moved over and we've attached 22,400 to work in process inventory. One thing I want to say here, because I think it's important, and I know that it comes up oftentimes in questions from students, and that is, well, how do you know this is right? Okay, you got 22,400. All you're doing is simply, aren't you guessing? First of all, you're guessing at this, you're guessing at this, which means you have to be guessing at that, right? And so as a result of that, aren't we just arbitrarily moving numbers around, taking values out of manufacturing overhead and attaching it to work in process? And it's a pretty valid concern. And the answer to that is, okay, well, it's got to be based upon something that's real and that has direct correlation to the activity itself. Direct labor costs are a pretty good stand-in for this. And we'll get into some other examples later. The 80% we determined as taking direct labor as a percentage of some budgeted overhead. And so as a result, we think it's got to be realistic, but it's an estimate, and we know it's an estimate. And the thing about estimates is they're always going to be a little bit wrong. And I think we have to be comfortable with the ambiguity there, okay? When we are talking about attaching overhead to inventory, we know that we're estimating, at least in the very short run, okay? So, but there are a lot of estimates that are made in accounting, and we have to be kind of comfortable with that ambiguity because we're dealing with something that is already a little bit tricky to begin with, okay? All right, now I said this work in process account is a giant account, and so what about these 22,400? Okay, well, as we encourage direct labor, we're simply taking 80% of that and attaching it to manufacturing overhead. So for job, and we got 3 different jobs here on this sort of aggregate job cost sheet. Job 101 incurred on January 10th, 9,000 of direct labor, 80% of that, 7,200. This is on the wrong line. And I saw this earlier and I knew one of these slides was off. And somebody in one of my other classes pointed out, why is this here when it should go here? It's a mistake. This 4,800 should go down here because they incurred 6,000 direct labor, 80% of that is 4,800. Okay, so again, that's 12,000. So 12,000 of that 22.4 is from job 101. On 115 and job 102, 4,000 was incurred, 80% is 3,200. On January 22nd, 5,000, and 80% of that is 4,000, so that's 7,200. And then one final entry is on job 103, and we get 3,200. So 12,000 plus 7,200 plus 3,200 is $22,400 that goes into work in process, but more importantly, goes into the subsidiary accounts for those particular jobs until those jobs are done. And this is a way that we attach overhead to the cost of production as we're going. And when would we do this? Well, we would do this whenever it's convenient to do so, but before the work is completed. Remember, in job order costing, we deal with what is historically fewer outputs. Remember, this is not process costing where we're making, 500,000 bottles of shampoo a month or 800,000 rolls of paper towels. These are individual jobs that are unique, and the inputs may differ greatly. And we talked a bit about that earlier. And so as the work is being done, as we're recording information like direct materials, direct labor, we're also recording manufacturing overhead, but we're estimating manufacturing overhead. And that estimating process is called applying overhead, and it's called overhead applied. And what happens if we're wrong? Well, we'll get to that. and we expect to be a little bit wrong, and it's just the way it is. So, all right, so if we go back to, remember we had 52,000 work in process before we moved over 22,400 manufacturing overhead, and that brings us down to 74,400. So all we've got now is sort of an aggregation of costs that we have now inventoried: direct materials, direct labor, and manufacturing overhead, 74,400, and we can further break those down by individual jobs. The 3 jobs this particular company is working on, okay? And remember, we would want to capture those costs because if we just go back to what some of the objective of job order costing seeks to do, it seeks to help us determine what does it cost us for the producer, what does it cost to do something, what does it cost to do an activity. That's really what the objective is there, okay? All right, so questions about predetermined overhead rate, what it is, etc. We are going to be talking more about overhead a bit later as this course goes on. Overhead is an interesting topic. It's one that it can be a little bit challenging at times, and so we have to pay extra attention, extra care that we're doing it accurately, and that we're making good estimates. Okay. All right. Before we move to the next learning objective, we'll talk about an example of Stanley Company. And this is a very simple example. These do not have to be overly complicated at all. Stanley Company produces safety devices for the year. Overhead costs 160,000. Estimated machine usage is 40,000 hours. Okay, they're going to use machine hours. They're going to assign the driver here. They're going to say is hours. So not dollars as in the example of Wallace, but a number. Okay, so 160,000 and 40,000 hours. So as a result of this, what do we have? We have 160,000 of estimated manufacturing overhead, about an estimated machine hours of 40,000. Gives us $4 per machine hour. So for job number 302, they use 2,000 machine hours. How much then do we assign to work in process for job 302? Well, it's 2,000 hours times $4. Okay, pretty easy peasy kind of stuff there. Okay. And then we'll talk about what happens as we get further down the road. Right now, the goods are not yet done. They're still being worked on. That's why we've got a work in process account. It's sort of it's a temporary account, I would say, in terms of capturing values. And actually, maybe the term temporary is probably not a good one. We think of temporary accounts as being more income statement accounts that we open and we close at the end of an accounting period. This is a permanent account, but the numbers flow through it, and they don't stay there very long. And the same goes with finished goods. That may be an account that numbers are reported, they're in, they're out, boom, as the goods are being transferred out to the buyer. So we're talking about numbers that are there temporarily, okay? Okay, let's move on to we have 2 more objectives in this module, and that is number 1. There's a lot going on in this particular section of the module. We'll talk a little bit about service jobs and what to do about that. We'll also talk about a particular costing method, which is related to job order costing, but is sort of unique kind of method of capturing costs that you may run into sometime in your existence. But again, just to recap here, when a job is completed, while it summarizes the cost, it completes the lower portion of the applicable job cost sheet. That was the totals there, okay? So as an example here, so now we've got all these costs together. And for job 101, so this is just job 101, whatever it is, okay? And they have all these costs that are incurring, direct materials, direct labor, and they've got manufacturing overhead assigned to that particular job. So they end up, at the end of, as this good is now nearing completion, we've got a total cost of production of $39,000. And the number of units was 1,000 units, right? 1,000 units, so 39,000 divided by 1,000 is $39 per unit. And this really gets us sort of to the heart of why we would use this particular system, why we wouldn't just dump all the costs into one big bucket and divide it by the number of units per month and then go from there. And we would do that in process costing, but in when it comes to job costing, it's a little bit more necessary for us to capture individual costs per job so that we can know whether that job is making sense or not from a sort of cost and revenue standpoint, okay? So in this case, what have we determined about this data? We said that, okay, it cost us $39 to make a good, whatever it is, some kind of electronic sensor. I think I was wondering out loud what kind of product it was selling in the first place, okay? Okay, and so if we go forward here with that, so here we go. Now the job is done, okay? The job is done. We've tapped, everything is done. And so as a result, we have these balances in these larger accounts, and we have 39,000 moves over into work. He's in work in process that now we want to take out of work in process and we want to put into finished goods, okay? All we're doing is moving these costs along. Remember, one of the metaphors that we used when we talked about costs that were being absorbed throughout the production process is the flow of costs is designed to match the flow of the goods themselves as they're being produced. So these goods are now done. So they're no longer work in process. So we have to take them out of work in process. So we have to put them in finished goods. But they're still in inventory. And all those costs are still tied up in inventory account. Remember, one of the key elements of financial accounting is this idea that we don't recognize cost of goods until those goods are sold. And it may take 2 or 3 years to make these particular goods. We certainly see that happen with certain long-term production schemes like construction and very expensive equipment. But in this case, we're aligning the physical flow with the product flow, okay? And then presumably we have sold the good. And so as a result, when we've sold these products, whatever they are, 39,000 comes out of finished goods, and now it goes directly to cost of goods sold, which is on the income statement. That's really the first point at which, first and only time that we recognize costs. All these other costs are tied up in inventory. They're prepaid items essentially, and we paid for them until we sell them. We don't recognize the cost. And so here's the flow of costs. We start with raw materials and labor and overhead. We have work in process. Then the good gets done. It goes to finished goods, and then the good gets sold, and it goes to cost of goods sold. So we recognize 39,000. And one thing that I think is interesting about this chapter, about this example of Wallace, and I don't think it's by accident, is that we never really are told what the revenue is for this. We don't really know what they sold this batch of products here on Job 101. So, and I guess it really doesn't matter. I mean, I know that in managerial accounting, cost accounting, which is sort of a subset of managerial accounting, is really focused on cost, almost to the exclusion of everything else. But managerial accounting does include the revenue from some activity, and we just don't know what that is. We're assuming that it's something profitable and higher than the cost of production, but we really don't know. And but for Wallace Company's sake, we hope that it is. But at least they know what it cost them to make that particular good. And if they're called upon to make it again, you'll allow them some guidance for pricing as they go forward. A lot of companies will simply determine what it costs to make something and then try to factor in some profit margin that is acceptable to the buyer. But they don't want to drop below that price off that cost, obviously, because that wouldn't make any sense. Okay. So any questions about how we move that over, how we absorb that cost? So notice too, what's going on is this: we're picking up these costs, these inventory accounts, and then they leave the balance sheet and go to cost of goods sold. They leave the balance sheet and go to cost of goods sold. Now remember, this is an important aspect of perpetual accounting systems. In perpetual accounting, perpetual inventory systems. In perpetual inventory systems, we're accounting for the cost of goods on a very frequent basis. Even as they're being produced, the cost is part of inventory. Okay. And that when we sell the good, not only do we report a revenue and maybe either cash or receivable, but we also reduce inventory and record cost of goods sold. And this differs from what? A periodic system where we would go back sometime after the fact, at the end of the accounting period, and say, okay, this is all what we did during the year. And we are going to go back now and find out what the cost of goods sold are based upon all these things that we've done. It doesn't work, and it's not desirable in a perpetual system. And job order costing sort of cries out for perpetual inventory accounting that is capturing in more or less real time what the cost of inventory is. And then when that good is sold, taking it off the balance sheet, putting it on the cost of, and reporting cost of goods sold right away, okay? And so we say it's more or less in real time. Okay, and then the flow diagram, and I don't know if this particular slide is all that useful, but obviously these are all in your text. These are some of the source documents that are used in order to go back and help to determine what these costs are. Source documents are interesting in the sense that they oftentimes are physical documents, or increasingly they're more associated with electronic files somewhere, where accountants will go back at certain points and say, where do we get these numbers? And we'll go back and we'll dig into the records, which is usually not too difficult to do, to grab these. Everywhere in accounting, source documents are used in various ways. I know in my experience in the tax world with source documents or any kind of document that refer to revenue or expense, and they're always trying to dig up and track down and chase down source documents. So that's all that's going on there. They make their way to a job cost sheet, which is simply an accumulation of costs for the particular job question, because we are identifying these by individual job. And I did want to look at this. This is this is a busy sheet here, or slide here. And I know if you're watching it on video, you might have to kind of blow this up a little bit. And if you're in the classroom here, it's kind of challenging. But this just kind of is a roundup of everything that Wallace did in this example. Remember, we started out, we had acquired 42,000 inventory. I think one of them was 32,000 and then 10,000. There were two different purchases. And then we were requisitioning these materials, 24,000, which was direct. And it went straight over to work in process. 6,000 was indirect, and so it was pending for a bit in manufacturing overhead. Notice that whenever we move something here, we're recording at least two different accounts. That's a key concept in accounting. Factory labor, we incurred 32,000, of which 28,000 was direct labor, which we moved over to work in process immediately, we absorbed in there, and the 4,000 we started put as pending in manufacturing overhead. We had these explicit manufacturing overhead costs, which I think took us to 19,800 or something, 19,380 or whatever. And then we got to 22,400, which was associated with this particular job that we then also moved over to work in process. So we moved this, direct materials, to work in process, direct labor to work in process, and manufacturing overhead to work in process. And as a result of this, we're doing this for some particular accounting period, but attached to this job, only 39,000 applies to job 101 and the 1,000 electronic sensors that they're making. So we're assigning 39,000 out of that to that particular job. 39,000 moves over to finished goods, and then we sell it, and it goes down to cost of goods sold. So I think that there's a lot going on here, but what I would encourage you to just sort of follow along and just kind of watch where the numbers go. And I think sometimes it's useful just to sort of follow the money here and follow where these things go. Because I think that will oftentimes help you to understand what's going on. Okay. All right. Questions before we move on to another particular variant of job costing. Okay. there's some example, there's some information here about job costing and we've said this before. In fact, we've made note of the fact that a lot of what we do in managerial accounting, even though it has sort of a manufacturing orientation, can also apply to service companies as well. Some examples of companies that might use these, and very often I think labor might be the driver that's being used, and so it is applicable to service industries, whether it's finance or healthcare or motion pictures. Okay, and then there's another kind of variation of job order costing, and it's called cost plus. And I think there used to be a retail firm called Cost Plus, but Cost Plus is an arrangement, okay, where a buyer and seller agree, and I think we see this a lot, or maybe not a lot, but occasionally, I guess, in construction contracts, or where there's something where the accounting for cost needs to really be, very, very accurately treated, like in government contracts. And cost plus basically means that there's an agreement ahead of time that says, okay, whatever it costs you, the seller, to do the good, whatever it is, to produce the product, make the service, whatever, you can mark it up by a certain percentage, okay? And then that certain percentage is the profit. We have agreed on that, okay? And that's what a cost plus situation is. So if, for instance, and it might be based upon something like a cost per hour, right? So maybe it's a cost per hour, and we're saying the cost per hour is $100 per hour. We've agreed on that. And we've also agreed that it's going to be at a 25% markup. So as a result, the cost is $125 per hour for whatever it is. Or I'm sorry, the price is $125 per hour. Remember, cost and price are not the same thing. Cost is more internal to a seller. Price involves the buyer. And so in this regard, the buyer and seller both agree. If this is and this is just an example here, if we're pricing this by the hour, we're going to pay $125 an hour because you told us that the cost is $100. The problem that I see with cost plus contracts is that, it sort of alludes to here, is that conflicts can arise. Number one, you've got to be able to the seller's got to be able to accurately record and be able to show these costs were incurred. And they're going to be able to convince the buyer that they're not boosting those numbers, whatever it is. And for their part, the buyer has to sort of be vigilant as well to sort of make sure that they understand what's happening, so that they know what the price they're paying is a fair price. And so, to the extent that can happen, that's all to the good. I do believe that in some government contracts, cost plus pricing is common. As an example here of a service organization, so this is just one of the examples out of the text. You've got Dorm Decor. Is an interior design company. They've done these things. They're working for State University, so as the customer. So in this case, they've got the following recordable events: 9,000 of supplies, 7,000 which are direct materials, 2,000 indirect. So we know the 7,000 is going to go to work in process. 2,000 is going to go to manufacturing overhead. Labor, salaries and wages, 100,000, 84,000 direct, 16,000 indirect. So work in process, manufacturing overhead. That's where they're going to be assigned. And then we're going to do an applied overhead rate. Again, it's a predetermined overhead rate at a rate of 50% of direct labor. So in this case, the direct labor was 84,000. And so 50% of that is 42,000, simply one half of 84,000. And then upon completion, we have a total cost of 34,000. Okay. So what's that look like at the end of the day here? We kind of have to maybe flip back and forth here a little bit just to kind of see what's going on. So, all right, well, we had supplies, and we had 7,000 direct and 2,000 indirect. And so we started out with supply. These balances are just sort of given. $9,000 total, 7,000 which is direct. And notice it goes to work in process, which we call something different. It's called service contracts in process, which is the same concept as work in process, where there's physical inventory. This is just a interior design, but it's still, the job's not done yet. And even, by the way, even in some service sector concepts, the term work in process is often used. I know that we used it in an accounting context when I was in an accounting firm. So, but nonetheless, it's the same thing. But just be aware of that. Then 2,000 of that goes to overhead because it was indirect. We have wages of 100,000, 84 which were direct, and go into the work in process or service contracts in process. 16,000 were indirect. Then we overhead of 42,000 applied. So altogether, we end up with a value for this particular job of $34,000, which we sort of subtract out of these totals here. And since the job is done, once we are saying it's done, then we book it as a cost of a completed contract. And one thing I should tell you is that there's some variation in income statement preparation. Cost of goods sold is pretty much cost of goods sold everywhere. If there's physical inventory, it's going to be called cost of goods sold. When it comes to a service business, it might be called direct costs, which in itself is maybe not a great term because you are capturing some indirect costs. It may be cost of sales. We see that often, cost of sales. So there are a number of different terms that are used there, but they all refer to the same thing. They're taking a particular job that's been accrued and they're moving it over out of the finished or out of this to some sort of finished situation, and it will eventually hit the income statement at that particular dollar figure. Okay. Okay. Big questions before we sort of round the bend here. I've got really just a little bit here to go, and then I want to get into the final bit about how we apply overhead and what happens when we have made some errors or gone too far or whatever. So I do want to get into that. So let's talk about some of the advantages and disadvantages of job order costing. Number one, some of the advantages, as we've mentioned numerous times before, it should allow for a more precise assignment of costs. All costs, whether it's overhead or direct costs, whatever it is. And it also allows pricing capability to be enhanced because it provides a measure of profitability for a job. But the disadvantage, this is a big one, it requires lots of record keeping, lots of record keeping. And to the extent that sellers are having challenges in recording and keeping track of cost, it becomes a difficult thing. And I'm thinking of small businesses in particular that just don't have the systems in place to adequately capture cost. And I know that there are lots and lots and lots of firms out there that are involved as construction contractors, construction subcontractors who really their costing should be on a job order basis because their labor moves around to different places throughout the workday, and materials are drawn from a common place and assigned to different areas, whether it's drywall paste might be on this job and in the morning and then on another job in the afternoon, that sort of thing. And but it's difficult for them just simply because of size, and there are often only a very limited number of people who do that. So, but to the extent that they can do it, it would enhance their ability to do better and more accurate pricing. Okay. All right. And here's one really quick one here. This is the only thing that's going on here. And then we'll move on to the fifth and final objective in this module. Is you got some jobs that are completed here. Job 109, job 112, and we move this over from work in process to finished goods. 112 is also done work in process to finished goods. The only difference is this job was actually sold, so the buyers actually acquired it. And so we now take it out of finished goods and book it to the cost of goods sold. Okay. So moving from work in process to finished goods to cost of goods sold. That's a very common process. Okay. All right. One final bit here, and then when we come back on Wednesday, we'll talk about we'll do some example problems and exercises from the back of the chapter. But this is sort of a logical place for us to end because. And at the outset of the class today, I said, okay, what do we do if we're a little bit wrong in our estimates, where we've got a little bit crazy, particularly if we've really wildly over or underestimated the amount of overhead for the year. And it's possible to do that. It's possible to be wildly out of whack for whatever reason. And, it may be due to reasons that are outside of the control of the company. Well, we've got to be able to figure out what to do when we have these kind of variances. And by the way, variances come up all the time in the business world, and nothing usually ever goes exactly as planned. So you're gonna miss here, you're gonna be over here, under here, whatever. In various cases, you're going to be missing some variables, and so we have to have a way from an accounting standpoint to deal with these. All right, so Wallace Company, this is the, again, this is an internal schedule, cost of goods manufactured schedule. It's an internal item where we had applied 22,400. We had 74,400 that was incurred in total manufacturing costs, and that we had this one particular job that was recognized as being done, and that was 39,000. So that's just an internal schedule. It looks a lot like an income statement, but it would sort of tie over into that. Okay. All right. Well, here's the thing. So what if, as we're applying overhead, and we're applying overhead on a routine basis, as we're capturing the information for the driver that's causing it, whether it's machine hours, labor costs, and we'll talk about some other examples of drivers later. As we're capturing this information, we're then applying overhead to work in process. And so what happens if we've got a positive balance at the end of an accounting period where we have overestimated, in other words, we've underapplied overhead? What do we do with that? Okay. Versus a negative balance in which we've overapplied it because we simply put too much in overhead. And then what do we do? So in this case, we've got overapplied to underapplied. So if applied is less than actual, it's underapplied. If it's greater than actual, it's overapplied. And so what do we do in this particular case? Well, the adjustment is going to work its way down to the income statement. So in this example, we'll go back to our Wallace Company example. And we said, okay, Wallace has, we're at the end of an accounting period. So, and we have a year-end balance, all right? And so they want to eliminate whatever variance remains in that account, which is just an account that estimates our total overhead that will incur throughout the year. And so we're going to either increase or decrease what? Cost of goods sold. It's got to go to cost of goods sold. It's got to make the adjustment there. That's where the adjustment comes into play. So in this case, if they have over or underapplied, we have to make that change. If there's a positive balance, we have to raise cost of goods sold. Why? It means we've underapplied overhead throughout the year. And so because we've underapplied it, we need to make up for that under application by raising cost of goods sold. If it has a negative balance, it means we've overapplied it, which means we need to lower cost of goods sold. And it's an adjusting entry. You might recall that from Principles 1, where we talk about adjusting entries. These are the kinds of things that are done sort of at the end of an accounting period, where we are doing maintenance. I mean, we're cleaning up accounts, we're bringing things current, and this is one of them, is this idea of overhead that has been applied, whether it's over or under, okay? So in this case, the example is that Wallace Company has a $1,400 positive balance in manufacturing overhead at January 31st. I guess that's the time period we're cutting off here. So they had incurred all these, 13,800 and all this, and they had applied 22,400, which means they were off by $1,400. It's not a huge dollar figure. It's not really that much of a huge problem. But because they've got a balance, they underapplied it, then we have to simply raise cost of goods sold because we did not apply enough overhead to production throughout the accounting period. So what we do is simply this. We make the adjustment of 1,400 and we include that in the cost of goods sold. So cost of goods sold, which would have been 39,000 for those 1,000 electronic sensors, is now 40,400. So what we can say then, after we've made that adjustment, that adjusting entry, that the cost of those goods were not $39 a piece, they're $40.40 a piece once we applied these figures in there. Now the question arises, and this is a good one. Okay, if we know throughout the year that we're going to take whatever we've actually paid, because we said these are hard dollar costs, and they're going to end up in cost of goods sold, then why did we go through all this rigmarole of attaching it to job 102, 103, etc., and make estimates based upon some predetermined number, when we know at the end of the accounting period it's all going to go into cost of goods sold? And the answer to that is it goes really to the heart of what job costing is. We're trying to attach all costs to the individual product costs themselves, including manufacturing overhead, which is somewhat tricky and challenging, and so we have to do an estimate. And so that's why we do it, so we can attach individual products. And we know, yes, all these costs are going to go into cost of goods sold. Every product cost will end up in cost of goods sold once the goods in question are sold. But it's important for us to know what those costs are of individual items. That's why job order costing is so useful. So in this case, we had a $1,400 adjustment. Here's what the income statement will look like, where we've got sales revenue, 50,000. This is the first time we've seen the revenue on this, which again is mostly irrelevant for our purposes up until now. We had cost of goods sold of 39,000. That was the initial value, right? And we make the adjustment down here. Cost of goods sold unadjusted and the adjustment for underapplied overhead, $1,400. And so as a result, 40,400 is the adjusted cost of goods sold, not the unadjusted cost of goods sold. And remember, before we get there, there's intermediate step, cost of goods manufactured, which is the intermediate, it's the value of finished goods throughout the accounting period. In this case, it was 39,000, but we had to adjust it. So now it's 40,400. So it gives us a net income for that. If that's the only thing that's sold during that accounting period, then 9,600 would be the gross profit. Okay. So it's only a cutaway of an income statement there. Okay. So that's what's going on there. We have to make that adjustment. And in sort of the, I guess, the real world, so to speak, I don't know that you would have these individual line items so much. You might just have, in fact, and I've said this a number of times before, but a lot of companies try to give these as abbreviated as possible. They'll have sales, then cost of goods sold, and gross profit. They won't get into all these line items. They may or may not even get into them in the notes to the statements, mostly because they don't want to sort of tip their hand as to what's going on. But in this case, we have got a fully extended income statement that sort of breaks those out. Okay. All right, and I think that there's only one other example here in the text, and that is applied overhead. So for the car company, the predetermined overhead rate is 140% of direct labor. Where did they get that number? Well, they choose the driver, then they determine what the overhead is going to be based upon their reasonable estimate. So they incur 90,000 of factory labor, of which 80,000 is direct labor. Direct labor, again, being the activity base or the driver. And so 140% of 80 is going to be 112. That's going to be the amount that's going to be applied, right? And we really don't care about the indirect labor so much here at all. We're recording it, we'll pay it certainly, but we're not really worried about it because we've applied 112, and as it turns out, we have actual of 119. So we've got a $7,000 under applied overhead. And so if we've under applied it, we have to make up for it, and we have to book that then as an adjustment to cost of goods sold. We have to raise cost of goods sold, in other words, raising an expense in order to deal with that variance. Okay. All right. Well, I think that sort of does it for are there any questions about anything with regard to anything that I've covered here in job order costing and whatnot? I've got a little bit of time here, and what I think I might do is just look at some of the examples of some problems and exercises from the back of the book, and hopefully these will be useful to you. And let me see if I can. I'm going to pull. I don't have the whole. I have to go to a different text here. So, but I do want to sort of take a look at these, and I don't know that I'll have time to get through all that I really want to, but we are working a little bit ahead of the pace here. So I want to take a look in chapter 12 here. And I want to go, this is job order costing, and I want to go to the end, and I want to go to the practice multiple choice questions. So let me get to that here. Practice multiple choice on 1227. Okay. All right, and let me bring this over here so that you can see that on the screen. Okay, there you go. So now you can see it. So anyway, I just want to spend just a little bit of time just because we've got time to do it. I wanted to look at some of these examples, and on Wednesday we'll talk about some further examples, and then we'll talk about the exam, which is on tap for this week. and go from there. But in this case, let's look at number one, practice multiple choice number one. Cost accounting involves the measuring, recording, and reporting of A, product and service costs, B, future costs, C, manufacturing processes, or D, managerial accounting decisions. And the answer is A, product and service costs. And remember, cost accounting is sort of this subset of managerial accounting, and it really is focused on the matter of cost and typically the cost of doing something, some activity, whatever the firm does, right? All right, number two, a company is more likely to use a job order cost system if A, it manufactures a large volume of similar products, B, its production is continuous, C, it manufactures products with unique characteristics, or D, it uses a periodic inventory system. Which of these looks like the best answer here?
C.
C, if it manufactures product with unique characteristics, and that is the case. Oh, and by the way, I could have checked on the right answer here. It's more likely to do it. So remember, similar products, and its production is continuous. That reminds us of mass production of things, massive production lines of, things like toothpaste and, and butter and whatever. I mean, the list goes on. And it also would not use a periodic inventory system because the best way to capture these goods is a perpetual system. So, and the one thing it talks about is the choice of a costing system is not dependent upon whether a perpetual or periodic inventory system is used, which I think is an interesting elaboration of this. You could use a periodic inventory system, but that's not really the key issue. And by the way, a perpetual system is much more superior in many ways. I realize it's not always tailored to every organization's capabilities, but nonetheless, where it's used, most companies are happy with it. Okay, let's go to number three. Let me see. In accumulating raw materials costs, companies add the cost of raw materials purchased in a perpetual system to what? Okay, well, this is interesting, and we have to kind of go back a little bit in our memories here about the perpetual system, which we talked about in 2110 Accounting 1. And remember that in a periodic system, we pretty much purchase all the purchases we make. We put into a purchases account, and it's just an account that just accumulates numbers, just goes up until the end of an accounting period, in which we add it to beginning inventory, subtract ending inventory, and we get cost of goods sold, right? But in a perpetual system, though, we're booking it straight to, in this case, it's raw materials, so it's going to go straight to raw materials inventory. It's not going to go to work in process because it really hasn't been put to work yet. But it is going to go into raw materials inventory. And let's be clear that raw materials, I guess, are associated with direct materials, but they don't have to be, because remember, raw materials are just any kind of material that a company is using as sort of a base for whatever it's doing, and they can be indirect or direct, either one. And they draw from a common source. They can go to different jobs, and the recording of where those materials go is pretty important to the discussion. Okay. Let me come down here let's go to number 6 here. Raw materials are assigned to a job when what? All right. A, the job is sold. B, the materials are purchased. C, the materials are received from the vendor. Or D, the materials are issued by the materials storeroom. The answer to that is D, when they're assigned out of the storeroom. And so that's really what's going on there. And the reason why is because it's going to once we assign them, once we pull them out, and whatever the storeroom is, it's a warehouse, store, whatever you want to call it, it's going to go to some particular place. It's going to be associated with theoretically some sort of materials requisition order. It's going to be approved by somebody who's got the authority to do it. Okay, particularly in larger companies that have very expensive materials, somebody's got to be responsible for it. They don't want to sign out too much. They don't want to sign out too little. They want to make sure that whatever they are checking out gets to where it needs to go. So in this case, the answer is D. Okay, and I think that I've got some ones that I wanted to do that are a little bit more involved. I think we've only got about 5 minutes left. I don't think we're gonna have time to do it. So I think we might just call it a day right there. When we come back on Wednesday, I do want to do just a few more examples and get into some numbers and some examples of things like absorbing costs, moving the inventory accounts, and all that. So we'll do that. And then I do want to make a good 45 minutes or so at least available so we can talk about the exam. This is also your chance to bring your questions. If you have questions about anything we've covered in chapters 10, 11, and 12, this is your opportunity to do it. It's not your only opportunity, it's not your final opportunity, but it is your opportunity to do it. And if you have a question, maybe somebody else does as well. And you might benefit from being present or watching, or at least watching the video on that. But if you do have questions, feel free to submit those to me, and we will go over that so you know what's going on. Okay. All right. Well, if anybody has any questions, we can go over that now. Otherwise, I will see everybody on Wednesday. Have a great day. Yep.